Hello and welcome to KYC. I am Sharad Dubey and the company on KYC's radar is none other than India's largest EMS player, Dixon Tech. Of course, a lot of, the stock itself was a darling last year itself, but we have seen some correction and also some kind of a degrowth in some numbers as well. But we will decode the entire segment and we'll have important parameters. But let's ask first questions why we want to know this company right now. Is it standing at its inflection point? There's expectations of a guidance cut impact coming for the smartphones as well. Will there be a much more pressure on the revenue as well, because the company has been growing at a very strong lot going ahead? Also, another question to ask is Dixon Tech sustaining its revenue numbers, and what would be the timeline for the backward integration? That's an important question to ask. And also, if you look at it, third important point is, will the consumer segment bounce back? The Q2 numbers we saw, they were on the muted side. So mixed signals are coming when we are asking the questions about these companies. Also, another question to ask in this segment would be, what happens after the PLI scheme for mobile expires? Will there be a new product categories the company will be going into? Or as such, will there be any other news flow coming in? So that's very important portion. Is the street factoring in the uncertainty in the new segments? They are going into new segments. Some of them are slight on a high margin basis, but are there any certain milestones to it? So that is something which we'll be watching out for. But let's look at the company itself, decoding the company. They are operating at 24 manufacturing facilities overall, and it's a leading provider of electronic manufacturing services. It's the lighthouse for the EMS services, the revolution which we have seen. Let's look at the revenue mix, how actually it has panned out. But majority of the revenue still comes in at almost 85% for the mobile and the EMS segment. Smaller numbers for consumer electronics, home appliances, and at once it had lighting segment revenue. Now see, because of product diversification, it is down to odd %. But now let's focus in the main parameters for the show, how we rate the overall KYCs. And of course, one by one, we'll be taking you across all the financial, non-financial, and even the strategic parameters which would be there. And if you could see on the screen itself, income statement, balance sheet, cash flow, return ratios, shareholding, street cred, and valuation and outlook would be the parameters which we'll be judging Dixon Tech for. So without further ado, let's go into the income statement, how actually it's panning out. And of course, the numbers are very strong and they have been growing on a year-on-year basis. The revenue number, the 3-year CAGR, that is 54% up. And of course, these strong growth numbers actually justify the higher valuations also, which this industry is currently trading at. Of course, a little bit of correction is there, but on the numbers front, it's been significant growth. And net profit, that's the number to look at. That's almost 1,233 odd crore rupees up. Also, let's look at the margin trajectory. It's flat at 4% because the nature of the business itself is a B2B business, and roughly there won't be much changes, but company is looking into new segments as well. So minor changes might be happening in the margin front. Q2 numbers, if you look at it, the numbers have been strong and margins coming in at 3.8%, net profit jumping 72%, while the revenue and net profit numbers were also good. So net, the overall, I would give a thumbs up and a 1 rating addition to it for the income statement. Now moving on, balance sheet, that has also been robust. If you look at it, the equity numbers, the book value numbers are decent. The borrowing numbers, not so much. That means the cash levels, that has also improved actually. So overall, if you see the important ratios, when we see the balance sheet, it is showing strength on a year-to-year basis. So that also itself, the balance sheet also takes care of itself. And over here we see a kind of, a positive momentum for this counter as well. So I would give a plus for this as well. But cash flows, there are two conflicting thoughts I would like to point out. The first one being, of course, the operational metrics. Operating cash flows has risen. That's a very good positive point. That's roughly 1150 crore rupees. But if you look at the cash flow to PAT conversion, it has been very high over the last 2 years. FY23, I speak about FY24. These numbers range between 250 to almost 150%. But this time that has come down below the 100% mark. So so what Dixon Tech generally sets the bar, it is so high. So of course, mere underperformance would still be on the negative side. Net cash flows, of course, there are changes happening here, not much. So I would give a neutral rating. something in the middle when it comes to the cash flows. The return ratios, that has been superb. Earlier, they were ranging between 25 to 30 odd percent. But then you see the development happening, the return on capital employed. That saw significant jump, almost 49% up. And this is coming in on the back of course, a significant jump in new business segments, especially the mobile segment. Of course, Street has been bullish, but ROC of a company which is in the B2B space likely, and in the EMS space, the numbers are very superlative. ROC numbers, if you see on the screen, they have been rising over the last 3 years steadily from 25%, then 33%, then 38%, and now almost at a touching distance of 50%. So that is a very superb number when it comes to the return ratio. ROE, another form of getting the overall returns in the Dixon Tech space, that's also ranging, but it has actually broken that portion. Between 20s range, it has broken and come into 33% in FY25. So of course, the base effect will also kick in as we go ahead. Why base effect will kick in? Because it's on a very higher side. So of course, Street might be factoring, will the company sustain these growths or not? So that's the question I'll also be asking to the management, that are these sustainable going ahead, or was FY25 a superlative performances? So net for return ratios, we will give a thumbs up to it and we'll add 1 point to the score as well. Shareholding pattern, that's also an important segment to look at, but Street is actually not factoring in so much of it because recently there was a kind of a share sell in the open market by the Dixon Tech's promoters as well. And of course, stock took a beating as well. Our promoter's stake was eventually always above the 30% mark, but this time, for the first time, it has gone below the 30% mark, and roughly 4% stake was sold by the promoters. FIs showing their support, not much decrease happening. It's still stable at 21%, but the number which I would like to point out is the DI's number. That's a significant absorption coming in, and that is coming in after the promoter stake sale. That shows that the institutional money is still vying for this counter as well. That has jumped up from 23% to 29%. Public, however, we are seeing profit booking happening in this counter, and over the last 6 months to 1 year, not much has happened to the stock, while we saw the other indices or the other sectors gaining more prominence. Of course, this sector was the hot sector, but it was last year. This year itself, there is some sort of moderation coming in, and that's why we are seeing the EMS stocks also cracking from their high levels as well. Number of shareholders, not much. Retail taking the money out from it, so it will be a thumbs down when it comes to the shareholding pattern. Also, our second last component to figure out in our KYC segment is the street cred. Not much happening in the returns front. 1 month, the stock is down 14%. Of course, this also shows the Q2 numbers impact. So that is why we are seeing much more selling happening. And of course, HNI selling was also there in a lot of counters for Dixon Tech. 6 month, not much happening. It's down 6%. And this year itself, not a great year for EMS stocks, especially Dixon Tech. That's also down 13 odd percent. 1 year, it's largely flattish, nothing to look at. That's up 4%. But if you are a long-term shareholder, if you have been holding the stock for at least 5 years, it has given you a 700% return. It is a multi-bagger in the long term, but in the medium term, in the short term, there has been pressure on the stock, and some overhangs do remain in the future going ahead as well. So overall, for the street cred, I would like to give a downward thumbs up, or I would say thumbs down. And out of this, we move on to our last criteria, that is our valuations criteria. Over here also, if you look at it, the valuations from the 12-month forward basis, that's around FY27. These numbers were once trading at 80 to 100 times, and now they have significantly corrected. And Dixon Tech, amongst its peers also, is actually, you could say, the averages is still favoring Dixon Tech as well. So both the peers status as well as from its historical high averages, Dixon Tech is somewhat at the attractive levels. But of course, this sector itself has re-rated. So these numbers which you see on the screen, they are the long-term average numbers. And of course, it is coming downwards. So there might be some value emerging in this segment. So for the valuation segment, I would like to give a thumbs up as well. And of course, the outlook, that's the most important part. And that is where the street is very confused. Market is forward-looking. And Q2 numbers, they were decent, but market looks at outlook, and the outlook still has some questions which needs to be answered by the management. FY26, the revenue guidance, if we speak about it, there, as per reports, they have cut it by almost 30 to 35%. So we need to get the real numbers in once the management comes. And the smartphone volume guidance, that has also been revised downwards as well. And of course, we have spoken about the mobile and the EMS segment, which contributes more than 80% of the returns. Now let's look at the margins improvement that's expected to go in. We have been speaking about the 4% totally margins coming in, but that's expected to go up by almost 50 basis points. Focus would be on components, telecom, IT, hardware verticals, while targeting 1 lakh crore sales in 3 to 4 years versus 39,000 crore in FY25. So of course, the long-term goals still remain the same, but the guidances for the short term for this year itself has actually corrected. So I would give a neutral impact when it comes to the overall company. But now let's just revise the ratings which we have given in our KYC segment. And for Dixon Tech, look at it. Income statement, balance sheet has been strong, cash flow neutral, but return ratios, they have been doing really well. So they are very good with the numbers. Shareholding and street credit, that has not actually been there. Retail shareholders have been reducing their stake, promoters reduced their stake. And while for street credit itself, not much to the shareholders, any returns if you talk about the 1 month or 6 month or even this year itself. But then valuations, they seem decent because of, as if you compare them from the high levels, and outlook itself, it's still neutral. There are some guidance cuts, of course, and the sales numbers, they are also expected to go up. But overall, for our KYC rating, I would be giving the company 5 out of 8. It's not still out of the wood, but the company, of course, is India's largest EMS company. It deserves premium valuations. That's what the street expects. But in future, there are some questions which need to be answered, and that we will be actually going about it. But now to actually decode this entire setup, we are having Saurabh Gupta. He's the Director of Finance and Group CFO at Dixon Tech. A very good afternoon, Saurabh, and it's been a while since we spoke, but Q2 numbers have also been announced. But the first question I would like to ask and get the numbers right, because reports are floating all around. Is there a guidance cut for revenue or the smartphone volume? And if yes, can you precisely say what is that guidance cut?
Yeah, so good afternoon, everyone. Happy Diwali to all of you. So my sense is there is no guidance cut. Broadly, I had mentioned in my in our earnings call also that we maintain our smartphone numbers to around 40 odd million. We are expecting certain approvals with certain brands, which one is not sure about the exact timing, but we are absolutely on course towards achieving 40 odd million. We have done 20 million smartphones. And in terms of revenues, yeah, my sense is the Diwali season has been great. The sales were buoyant. So clearly we are looking at a very decent Q3, generally, hopefully a better Q3 than what has been the historical trend. And we have a very strong order book across verticals. So my sense is even at an overall level, we should have a sub 40% kind of a growth this year. But definitely next financial year, we are expecting to double our turnover from the levels where we were in 24-25, and with some kind of a margin expansion, which will happen on account of a backward integration strategy.
Sure. And Saurabh, I have a question for the segment of the smartphone volume guidance. Are we looking at that range between 40 to 42 million units as per reports, or will it be a bit more on the higher side?
No, it will be closer to 40, 42 million. So we are pretty much confident about that number, yeah.
Sure. Apart from this, the new segments which, the street is, of course, there's a question around it, like, what will be the timelines to it, the margin segments. So if you could just explain us, if any new categories which you are moving into, and what kind of, leadership you are expected to, get in these segments. Just, you could just point out the margin profile as well as the segments which, you would be focusing on, Saurabh.
Yeah, so this year, 6 months, our margins were in the range of 3.7, 3.8%. I see them at a similar level for the entire financial year. But as and when our backward integration play of display, of camera modules, and other backward integration play on mechanicals start to play out over the next years, the margin profile will continue to go up. Other businesses like telecom. We have a very strong order book, not only from our anchor customer, but we've also got a large order for a non-CP product, basically microwave radios, with a large US brand, both for domestic market and global market. So that should add to our revenues, and also to that will come at a decent margins for us. And also IT hardware, as and when in the next 6 to 12 months, even IT hardware business should start to show numbers, because the order book is increasing with all our anchor customers. Our JV with Inventec should be operation in the next 6 months. And there also we plan to focus more on backward integration of SSDs, memories, and the power supplies. So unlike mobiles where the backward integration happened after a gap of 3-4 years or 4-5 years from the initial levels, here the backward integration will start to play out immediately. And mobile, of course, we are looking to, of course, consummate this JV that with a large brand. And also we are also got a large order from a large global ODM, and that should also start to reflect in our numbers from next financial year. So overall, the order book for next year looks very exciting, especially across these three verticals. And in the refrigerator category also, we are expanding, getting into new categories of side-by-side, frost-free, visi-coolers. So there also it's an ODM business for us. So that should also have a positive impact on the margins. So year on year, you should see a margin expansion, largely on account of all these parameters. Yeah.
So if you have to quantify this margin expansion, can we expect a 4.5% margins coming in on a blended consolidated basis in the numbers by next year?
27, 28, there can be 100 to 120 bips expansion. 26, 27, hopefully, yes, you are absolutely right. The margins can be closer to around 60 to 70 bips margin expansion, half of that. So broadly, anywhere between 50 to 70 bips kind of a margin expansion is possible, yeah.
Well, that's pretty interesting regarding that. But the question remains is backward integration. We spoke about it. Some of them timelines will start now as well. And what would be the entire backward integration, timelines, if you could just suggest? Is it for just the one sector you're talking about, or is it just for a couple of sectors that you just mentioned? Just you could just give it a clarity for our viewers that what is the exact timelines coming in for this segment of this backward integration, Saurabh?
Yeah, so as far as the camera modules are concerned, we acquired this company called QTech India. So that has started, that got consolidated with our numbers from 26 September. So that should reflect in the numbers in Q3 and Q4. They're already doing a number of closer to 2,500 kind of a annual run rate, 7.5% margin. Over the next 6 to 10 months, we want to expand the capacities. We want to basically deepen the level of manufacturing, take advantage of the component PLI scheme. So what the numbers that we have targeted for ourselves is that this 40 million of volumes and 2,000 crore of revenues, we should hopefully in the next 2-3 years, we want to take it up to almost 190 to 200 million camera modules with a turnover of almost 5 to 6,000 odd crores. And this will all come at a very good margin. The margin should expand from 7.5% levels to 9.5% level. The display with HKC should start from Q1 of next financial year. The machines will be installed by Q4. The trials will happen by Q4 of this financial year, and the mass production will happen from Q1. And so that's there. And the other backward integration for mechanicals and the batteries should hopefully take another, my sense, 12 to 15 months, anywhere between 10 to 15 months. And another component that we are targeting is a optical transceiver, which should also happen over the next 6 to 12 months. So combination of all that, we are committing an investment of almost 3,000 crores. There will be largely a captive play. And yeah, so that will be the largest trigger for a margin expansion, along with, of course, more ODM business and more operating leverage coming in.
Well, yes, we spoke about the expansion plans. We spoke about the timelines in this entire backward integration segment. Hopefully, an incremental margin bump up in the company. But the street is still spooked, and that's the most important question which you keep on getting it from across the space is the expiry of the mobile PLI scheme. Now, what happens next? What's company's strategy? Will the company, go more into this mobile segment without the PLI scheme, or the PLI scheme is needed going ahead? What happens now? What is the contingency plan?
See what we understand from the government that the mobile PLI has been a big success. India has started exporting mobile phones worth 25, $30 billion, and the number will continue to go up. They're talking about a target of 60, $70 billion, largely led by Apple, Samsung, and of course, we also exported almost 3,000 crores in the first 6 months of this financial year for our anchor customer. So discussions have already been initiated with the government. Government is, of course, looking at the data, and they want to support the mobile sector. So there are good chance that the mobile PLI may get extended. But assuming that it doesn't get extended, all these things which I just mentioned to you on this backward integration play, also the internal efficiencies, the investment in automation, robotics, investment in talent, uh, taking our industrial engineering to the next level. So assuming a scenario where it doesn't get extended, so still we feel that the backward integration play can more than compensate for the PLI which goes away. And the margin expansion, which I just mentioned to you, takes a scenario where the PLI doesn't get extended. So if the PLI get extended, then it can be altogether even a positive scenario for us.
Well, that's what the street and the industry are hoping, that PLI gets extended, and of course, this has done wonders for the nation and for the company as well. But let's point out, apart from this segment, the consumer segment, the Q2 numbers were not good, and I'm just delving into the Q2 numbers for this consumer segment itself. Of course, there was GST issues, there was a little bit of supply chain confusion as well. Is that going to spill over in the third quarter as well? Consumer segment, there might be a pressure again in third quarter, or are you seeing that bottoming out?
Yeah. So what Q2? What exactly happened that mid August when the some kind of a announcement happened, and then the effective implementation happened on 22nd September. So sales got pushed because everybody was expecting that the rates will be cut post September 22nd. But those 9 days were not enough to compensate. So we saw a loss of sales in our television business, refrigerators, as well as washing machine business, which is generally a good season for us just prior to Diwali. But what we have been talking to our channel partners, our customers, this Diwali sales have been phenomenal. So there's a lot of buoyancy in the Diwali sales. So clearly the secondaries have happened, which will mean that we will have more business in our primaries. We'll have more sales of a primary business in November, December. So we are expecting a better Q3 as compared to the historical Q3s that we have seen.
Well, that's pretty interesting for this Q3 numbers coming in. That's a very important statement made by the management, and that we'll mark as well. Last question before leaving, Saurabh. The company is targeting 1 lakh crore sales within next to 3 to 4 odd years. Current product composition, we know, we have discussed this earlier. The new ones, especially telecom and IT hardware verticals, that's where your bullishness is coming in. Telecom, we are seeing there's a massive change happening in India, be it the infra gear space or even the telecom space as well. So what would be your commentary, final commentary on these new segments, telecom and IT hardware?
Yeah, so telecom business for us couple of years back was just 700 crore business. This year it will be closer to 5,000 odd crore business. So clearly it has grown. And with the kind of order that we have received from, of course, one is the internet penetration. You will continue to get large orders from your anchor customer, the overall Indian internet penetration story. But secondly, we are now focusing also on the non-CP product devices. So we have got a large order from this US brand, which in itself can be $150 million for us. So next couple of years, definitely we are targeting that if we can take our telecom business closer to almost $1 billion. So that is something that we are targeting with a decent kind of a localization and also a decent margins. IT hardware business, our JV with Inventec should be operational in the next 6 months. We are already manufacturing for a couple of large brands, and the volumes are going up. So in next couple of years, there also we are seeing that the revenue potential can be closer to, if not 1 billion, closer to 600 to 700 million dollars. So both these businesses will, along with mobiles, will be the largest triggers for our growth. And then again, we have an expansion plan in lighting where we have done a JV with Signify. So the idea is to keep moving into more indoor lighting categories, more premiumization, professional lighting, and also look at the exports. We have already got some pilot orders from US retail chain, and we are working to make it more sizable for us. Refrigerator, as I mentioned, clearly in the 3 years, in 2 to 3 years, we plan to triple our revenues there because we continue to expand more into other categories. And the company is also evaluating more opportunities for growth. We are open to acquisitions. So yes, yeah, so a lot of work is going on in each of the verticals, I would say.
Well, yes, so it is a lifetime work in progress and a lot of announcements also coming in. So we will be also looking at the counters, and so will the shareholders as well. Thank you very much, Saurav, for taking out your time and giving us season's greetings to everyone present at Dixon Tech and your family as well. Thank you very much, Saurav, for
Thank you
joining
so
us.
much. Thank you so much.
Well, an interesting take today on Dixon Tech, and that's all, folks. Thanks for tuning on to KYC only on NDTV Profit.